Well, technology actually accounted for 50% of the sector ETF flows so far this year, really dominant, both in terms of flows and also in terms of performance. And to your point, it's really leading the performance so far in US equity market, accounting for almost all of the year-to-date positive performances. So we do see tech leadership being a major driver so far this year, and that could continue, especially if you think about different from the 2000s where earnings weren't coming through. Actually, this time around, tech performance, outperformance has been supported by significantly better earnings performance as well. So if you think about the recent quarter of reporting, tech actually managed to grow positively versus the broader US equity market, the earnings growth actually contracting quite significantly. So we do see some of the outperformance being justified and some of the broader structural trend, digitalization, working from home, very much accelerating this focus on technology sector. So we continue to like it as a sector. Now, having said that, there is room for the leadership to spread out as well, because if you think about what right now coming out of a recession, right? We're slowly coming out of a recession, and it's natural to actually see some of those leadership at times rotate and potentially more broadly spreading out. So in addition to tech, I think there are other sectors that we could consider as well, especially as we position for a US election in November, and some of the sector plays are very much how investors like to approach events like this.
And I hear you about that spreading of leadership as well, but my concerns are, despite the fact that, again, nobody on this desk is saying these aren't amazing companies, what we are having concerns about, and probably the same concerns you've got as well, is about the value of these investments, i.e. the valuations on the markets now have gone to utterly extraordinary levels, no matter how good you think these companies are, no matter what you think about Tesla, Amazon, even Apple. The multiples have gone to pretty much record highs in many cases.
Yes, multiples look a bit stretched, but if you think about the environment that we're in, we're talking about zero rate environment for the foreseeable future, 3 years, potentially even longer. And this kind of environment means that the discount rate that you use to discount future cash flows is going to be a lot lower in comparison with past cycles. And as a result of that, those cash flows in the future are looking a lot more attractive right now. So yes, it's important to kind of look at relative valuation levels versus historical averages, but we have to take that with a pinch of salt, because the environment that we're in is truly unprecedented. And not to mention this TINA phenomenon. Yes, equities may look a little stretched based on the multiples that you look at, but within credit, within fixed income space, we are seeing yields pushing really unprecedented levels. And where are you going to allocate your risk? And also, it has proven incredibly costly so far this year to stay out of market. Our clients are telling us so. So if they have to put risk to work, if they have to put cash to work, where else are they going to put it other than where you see driver growth coming through, technology really seem well positioned, and also some of the laggards in terms of equity markets, European equity so far lagging US equity markets, even though fundamentals look more robust and policy response look more coordinated at this point. This is where our clients want to actually put assets to work.